November 28, 6 p.m. Eastern Time. We're looking at the S&P. We've been discussing how there should have been a high around the middle of November, and that we're expecting a decline in December, and that we haven't seen the real decline yet, and I think there will be more to come, and that the likelihood is that we'll see a little bit more decline into the report on the Fed report. Possibly that the market will go back up one more time into the 8th of December, followed by a bigger breakdown into the 15th, possibly even the 26th of December, before it finishes its December correction. And remember that this is a correction. It is not the beginning of a bear market again. And it had started in October, and it's likely to continue into January and potentially even until April of next year. So what is happening now, though, the emphasis should be to be shorting. There's a possibility the next week or so we'll see a little down, another up, and then we can have a serious decline that would take us down to 3750 to 3700 area, which is what we've been waiting for. Very likely to happen. It's just setting up. It's taking some time to set up. There are two charts I want to share with you. The first one is a couple of price projection targets. The old-fashioned Andrews median lines, sometimes called the pitchfork lines, using the intermediate term swings that we've been seeing lately. The two lines indicate a target for the short term, and then that light blue target line is the first one, and then there's a lower one on a bigger swing down around 3,700. Both of them should get hit. The first one probably in the next day or so, and that's approximately 3850. Then it's possible that after the report we'll see another rally, which would fill the gap that it left today and possibly take out the highs of this most recent time period between now and November 14th. In any event, you're looking to short this market until the end of the December period, and possibly the tick low may come in around the 15th of December. And then there could be a retest at the end of the month. Alrighty. And the second chart I want to show you is a daily chart, and it's pattern recognition, again, showing a couple of different variations of what is ultimately a very, very important cycle in the markets. Multiples of 37.5 years going back from 2022, you get every single time a secular bear market. You get it in 1984 going through until ultimately you could think of the 1987 low as a completion of that wave. And then you had it in 1946 through 1950. You had it in 1910 through 1914. You had it in 1874 through 1878. You had it in 1837 through 1842. You had it in 1799 through 1802. Every single time you've had a major bear market on this 37.5-year interval, and it's caused by an astrological event, which is the cycle of Rahu. And it's two cycles of Rahu, 37.2 years. Seems to be an exceedingly important cycle in the stock market. So we're in a market that, even if it goes up a little more, it has a long way to go before it's done. And if you consider the beginning in 2022, at the beginning of January of 2022, we're looking at least 2025 or even 2026 before the final C wave, the final decline comes in. Now, we could have some rallies in the middle, but a bull market is not likely to start, a real bull market is not likely to start until at least 2025, possibly 2026. And that doesn't leave much room for the long-term investors to make money in the stock market. Ergo, there may be better ways to invest your money, and we can discuss some of that in the next video. Looking forward to seeing some more thumbs up, and really grateful for a large number of subscribers have come in this week, and we have a lot of knowledge we'd like to share with you guys. Thanks a lot. You take care. Bye.